Big topic today, Adam.
This is huge.
Yeah.
This is huge.
Yeah.
When I first started speaking on college campuses in 2004, there was $200 billion in student loans. $200 billion.
Okay.
Fast forward to 2014, there was $1.2 trillion.
Wow.
So it went up $1 trillion in 10 short years. And $1 trillion, we throw that around a lot. Our government's $1 trillion. The deficit is $1 trillion or more, right? But can I give you some statistics on $1 trillion?
Yeah, please.
So if an F-14 took off out of an airport and it flew peeling off $100 bills behind it sequentially, right?
Okay.
It would have to fly for 14 and a half years at the speed of sound to peel off $1 trillion.
Wow.
Yeah.
For 14 years.
14 years.
Wow.
Western civilization wasn't even around 1 trillion seconds ago. So literally, like, people were clubbing men were clubbing women and dragging them back to their caves 1 trillion seconds ago.
Seconds ago?
Yeah.
Wow.
Yeah.
Oh, that one opens up perspective.
Crazy, right?
Yeah.
So we went up $1 trillion in student loan debt in 10 short years. Today it's closer to 1.6, almost across the 1.6 trillion.
That is crazy.
Yeah. So let's talk about how we pay it off.
Let's talk about that.
Okay.
So, how to pay off student loans. There's particularly with this, one of the things that I want to talk about are ways to do it, right? Because unfortunately, there are people who have student loans, right? Can't necessarily get out of them. And so the conversation is, okay, now that I have them, how can I pay it off?
Yep.
The first thing that I'll always tell college students or recent college grads is that they can reduce their interest rate on the student loans by setting up auto pay.
Yep.
So if you set up auto pay with your loan provider, they'll typically reduce your interest rate. If it's at 6%, they'll reduce it 0.25%. So the 6% will then go to 5.75%.
Yep.
So you're paying less money on interest, which would then have you be able to pay off your student loans faster.
Yep.
So that's the first thing that I say people need to do.
Cool.
The second thing is that it really is a mindset. It's like, hey, I have student loans and I am committed to paying it off.
Yeah.
I graduated in 2014 with $35,000 in student loans, and I told myself that I would pay it off in 3 years. And I ended up paying it up in 3.5 years. And there were a lot of different factors that went into it. I moved from San Francisco, where I was paying $4,300 a month, to living at home and paying no rent.
Crazy.
I was starting my own business.
Yeah.
So, the intention of, and also my income got cut. So when I was working in San Francisco, I was earning $116,000 a year. Then I ended up working at a startup, and I was earning $1,450. So I took like a 76% pay cut. My parents were very happy.
I bet.
And so obviously that impeded my ability to be able to pay off the student loans. But any extra money that I was generating as I started my business, it was going off towards student loans.
Yep. Yep.
So any extra payments, that's exactly where it went. And specifically, I think it was a total of 7 to 9 loans that totaled up to $35,000.
Right.
And being super clear on what the interest rates were, what the balances were, really allowed me to create a game plan in which ones to pay off first.
Cool.
Yeah.
Your comment about it's a mindset triggered something for me, and that is that I always tell college audiences that if it takes you 4 years to acquire the debt, it shouldn't take you 21 years to retire the debt. And the average amount of payoff now today is 21 years.
For student loans?
Yes.
Wow.
So if you are somebody who's graduating from college, on average, it's going to take 21 years to pay that whole thing back. If you go and make the minimum payments or set up, income contingent plans or long-term repayment plans.
I thought it was defaulted 10 years. No.
No.
Wow.
No.
Oh my God.
Yeah.
Oh,
yeah.
wow.
So 21 years. So someone that borrows, let's say, $40,000 in student loans, over the course of 21 years would pay back almost $78,000.
Wow.
Yeah. So it's a staggering number. So this whole idea of it's a mindset of I went to school, I borrowed money to do it. It's necessary for a lot of people, and there's benefit to it for sure. But it's deciding at some point, I just don't want it anymore. Yeah. I'm going to get rid of it completely. Yeah. And that's kind of our take on it, right? There are some people who would say, oh no, pay the minimum and pay it forever. I just don't particularly subscribe to that notion. I would just as soon get rid of it. So let's talk about how to do that. Nick mentioned throwing in extra payments, but you got to be kind of careful about how those payments are sent in.
Okay.
Right?
Please elaborate.
Okay, so if you mentioned you had 7 or 9 loans.
Different loans, yeah.
And for those of you that have borrowed money, what will happen is every time you took out a loan, so every semester you were in school or anytime you took out an emergency student loan, there was created a loan number for that particular instance. And at the end of your college career, you might have 8 or 10 loans in a basket of loans that are all serviced by a servicer. So that might be a Sallie Mae or Navient or any one of those,
Great
right?
Lakes.
Yeah, Great Lakes or any of these. So the servicers are taking whatever payment you're sending in, and let's say on a $400 or $40,000 student loan balance, your payment is $379 or $380. Okay, or let's round it up. Let's just call it $400. $400 comes in, and Great Lakes Servicing says, "Thanks for your payment. We're going to send $20 here, $40 here, and $60 here." And $12 to this small balance, but they take that $400 and they splay it out over all 10 loans in that basket. If you are making lump sum payments to your student loans, and you make the mistake of just saying, "Oh, I sent in an additional $200," well, Great Lakes or any of the other services are going to take that $200 and they're going to send $12 here and $8 here and $13 here, and effectively what they're doing is they're keeping the payments longer, right? They want you to be indebted to them over a longer period of time.
Yeah.
So instead of doing that, what we recommend you do is any additional payment that you're making, be it $50, $100, or $1,000, you are going to send that to one particular loan in that bucket or basket of loans. So the rule of thumb really is that you go after the lowest balance loan first, just to knock it out, get it completely out of there. And what I found 9 times out of 10, Nick, is that somebody has like a book loan, right? Because they needed books one semester and they got a $400 loan. And that $400 loan is getting like $3 of the payment. You know what I mean?
Yeah.
So we want to just knock that one out and move up to the next one.
Yeah.
Questions or comments on that?
Comment. There really is something to be said around you being able to go from 7 loans to 6 to then 5 to then 4. Because when I saw my loans decrease and disappear, it just gave me that much more inspiration and a new level of commitment to just knock them out. What you're talking about in terms of the loan service providers, spreading out your payments, is very inefficient. Sounds very inefficient.
Oh, it's crazy. It's like, the analogy I give is if I gave you a piece of white bread and I said, "I want you to toast this bread, and you can either use a blowtorch or a flashlight." And you're like, "Oh no, I'll do the flashlight." And you just stand there and you're, waving it back and forth over your piece of bread. It's going to take you 21 years to toast the bread.
I'm hungry.
Yeah, I know, I am too.
Can't wait.
We should put some peanut butter on that toast. So if you take a blowtorch, which means you're going after the lowest balance loan first and knocking them out one by one, it will feel like you're going to get a lot more traction and make more headway that way. Furthermore, if you start out with a $40,000 loan balance and you're looking at that number slowly go down, versus you look at, I had 8 loans or 10 loans, now I have 9, now I have 8, now I have 7. That's a much easier way to just begin, again, getting some traction on it.
And to keep with the food analogy, it's much more digestible.
It's digestible.
It's digestible.
For sure.
One thing that I also want to share, this was really interesting, and this is a recent ruling by the IRS. They're actually allowing companies to be able to match their employees' student loan payments into their 401k.
Yes.
So, as a lot of college students are graduating and they're getting into their first job, second job, whatever the case is, the conversation is always, one, I have student loans that I need to pay back, but I also need to save for retirement.
Totally.
I can't necessarily do both.
Yeah.
So one opportunity that really showed up is that companies are allowing their employees to pay off their student loans and really take that as the contribution amount that the company will put into their 401k.
They'll match that payment basically into their 401k.
Or to a particular percentage.
Right,
Which is very, very helpful. So, when if you're about to graduate or if you recently graduated or you're in job transition, that is definitely a question that I would ask the employer or the company to see if they do that.
Yeah.
Because it's definitely an added benefit.
Absolutely.
Yeah.
Not only that, but there are a number of companies now that are either helping to make payments or they're figuring out a way to do profit sharing back to student loan payoffs. There's a company called Peanut Butter, oddly enough, awesome. But it's getpeanutbutter.com that helps companies set up these policies where they will help make additional payments to student loans. So if you're someone who's graduated, you've got student loan debt, you might even consider either talking to your HR department about introducing a policy like this, or if you're looking for a job, finding companies that are helpful in paying back student loans because they know, obviously companies want their employees to stick around. And one of the greatest, I think, loyalty inducers is helping graduates pay off their student loans.
Yeah. Sounds like a jam.
It does. Dude, that's my jam.
that's
Peanut butter is my jam.
That's
I
awesome.
am really hungry.
Yeah.
What's up tomorrow, Nick?
Well, I want to talk about the challenge first.
Oh, that's right.
Yeah.
My
So
bad.
the challenge is to if you have student loans or any type of debt really, but particular student loans, know how much you owe on every balance. So whether you have 4 loans, 8 loans, you want to know how much those are. Because like Adam was saying, it might be a textbook loan that's only $250.
Yes.
Or there might be one that's $12,000.
Right.
To be able to know exactly how many loans you have, what the balance of the loan is, as well as the interest rate, and then being able to target the smallest balance amount and knock it out. So the challenge is to find out what's so around your loans. Find the smallest one and then declare for yourself. Choose a date by when you will pay that off.
Love it.
Yeah.
Yeah, that's good.
Be one less thing to worry about.
And if you're concerned, or if you're thinking, well, how would I do that? Where does the extra money come from? One of the things that we recommend is figuring out how could you make a little extra money on a weekend? If it's, picking up a waitress or bartending shift or selling stuff on Craigslist, could you make an extra $20 or $50 every single weekend that you then flip to a student loan to get it knocked out that much faster?
Yeah.
So we hope you've enjoyed the how to pay off student loans. Huge topic. I'm sure we'll come back to it time and again. What's up tomorrow? Can I ask that now?
Yeah, you totally can.
Okay, good.
Tomorrow we have a That Just Happened. Personal favorite.
I've got a huge one.
Yeah.
That's going to be fun. Yeah,
Awesome.
We're going to have fun. Join us tomorrow, Explorers. Like, subscribe. Make comments down below. If you're on YouTube, send us an email, questions@masteryofmoney.com.
See you tomorrow.
Until then.